How is everybody? Happy Thursday. Happy Cinco de Mayo, actually.
Cinco de Mayo.
Cinco de Mayo. So hopefully you guys are going to get some good tacos today. So I wanted, and this shouldn't take very long because I was trying to, and I know it's been a few weeks since we've kind of done our series, or a few times we've missed, and but I know we've talked about FHA, we've talked about VA, and we haven't really touched on conventional. So I'm going to kind of mix today like conventional financing with like jumbo, and kind of how we get around jumbo too. So that's what I'm going to talk to you guys about today. So conventional financing, conforming, our loan limit, actually, let me see if I can, oh, you know what? I don't think I have it on here. Never mind. So conforming loan limit, changes, let me take that back too. Doesn't change every single year. There's years that I've been in this business that it hasn't changed, but each year, and for the last few years, it has changed, and has gone up. So conforming loan limit has gone up, every year, January 1st. Sometimes we hear like November the year before of what they think. So it's actually for this year, starting in January, 147,250. I think I told you guys that before. Not sure why they throw on that 250 to throw us off for something. Just you can't just 247 would have been great. But so in our county, and I'll speak on our county first. So Solana County, anything above that is considered jumbo. Jumbo is, I always say, it's kind of it's a different beast. So it's different guidelines. Things are stricter. It's a little riskier for the investors. So they're going to have what we call overlays. So they usually want to see higher credit scores. They usually want to see, typically, depending on the investor, but typically they want to see like 12 months of reserves. So not only your down payment, your closing costs somewhere, but they want to see, 12 months of reserves as well. They normally usually cap what we call our debt income ratio. So if we kept our loan amount at that 647 mark, we could usually go up to 50% debt to income ratio. But when you get into kind of the jumbo world, a lot of them cap us at like 43. So that kind of brings down our purchasing power as well. So not everybody has, and then also down payment wise, they usually want to see 20% down. There's a few investors that will go, 15% down, couple maybe go 10, but they're a lot more stricter on things. Typically most want to see 20% down. So, a lot of people don't have, the 20% down plus an additional, 12 months of reserves plus, a 740 credit score. So, it's a kind of a smaller box you have to fit into. So a way around that is we do what's called an 80-10-10. So it's an 80% first. And if you guys have, I think most of you guys are fairly new in the industry, but Amy probably remembers this back in the day when, mortgage insurance was around way back then, and then it went away, and then seconds came aboard, HELOCs, which replaced mortgage insurance because our values kept going up higher and higher. So we do like an 80% first. So we would keep like our first at a conforming loan limit. So we keep it at that 647 or less. And then it's a 10% second and a 10% down. So this eliminates a few things. So number one, they don't have to come in with, 20%. Number two, we can underwrite by Fannie Freddie guidelines, our traditional, conforming conventional guidelines. So they don't need reserves. We can go up, actually, it depends on the second on what our debt to income ratio is. But the biggest thing is we can go down in credit score, and we don't have to have that reserve requirement. So that's kind of how we get around, jumbo. Now in each county, it's different. So like in Napa County, whereas our county, anything over 647 is considered jumbo, and Napa County, and I believe I'm trying to think of the top of my head because I haven't memorized all the loan limits yet, but it's like, I want to say it's like 915,000. So anything over that is considered jumbo. So each county is different. So you want to definitely, you're working with a lender and you think you might be jumbo, whatever. I mean, make sure you can look up the county loan limits, which is helpful because I've actually had, and this happened just not too long ago, where I was saving a loan because it was an out of county or out of area. I think it was even out of California, may have been, but they weren't familiar with our county limit. And we actually, it held up our transaction because, and they went through underwriting and everything got denied because they had the wrong limit, the loan limit, and now they didn't qualify because they were told they had to bring in more money because it wasn't structured properly. So that I've seen that a few times. It does come into play. So kind of knowing the loan limits, and like I said, you guys can look it up. You just Google, Fannie Mae loan limits. You can do it for FHA too, because FHA is different, like we talked about before. But you can Google, FHA loan limits, and it will go by county. So I would definitely recommend you guys checking that out. Do you guys have any questions from what I've said so far?
What type of buyers typically go after jumbo loans?
Well, I mean, as our prices have, gone up, drastically in the last, couple years, just, more than usual. We're seeing more and more people do jumbo, but it kind of just depends on, especially in our area, kind of where you buy. And like I said, there's not a lot of people that have, a ton of money to put down. I mean, there is, like what we're seeing, and Amy probably sees this, I'm sure sees this too, is people from the Bay Area that sells their house there. They have, they have a lot of money, but they're still, they're wanting to buy in the $1 million range, but they're still considered, a jumbo loan amount. So like I said, it just depends, like criteria wise, they have to have, good credit, and they have to have reserves. So did that answer your question?
Yeah, thank you.
Okay. So yeah, I mean, jumbo, like I said, it is a different world, and the guidelines are stricter, and it depends on who we sell the loan to as well. So a lot of times we're selling them to the big banks like the Chase and B of A and Wells Fargo. But it all depends. Sometimes the other thing that kind of makes the difference with jumbo is appraisals. So sometimes, depending on, again, depends on the investor, their situation, but sometimes we have to get a second appraisal or a collateral review. So like we could close loans in 15 days, but on a jumbo, we actually need that 30-day period because of kind of some extra steps and underwriting that we have to do. And just again, because it's a riskier loan, it's more money, and it's their, investor requirements. Now, going back to the 80-10-10 option. So again, that we would do an 80% first and 10% second. So that 10% second, we have a few investors that we can sell those to. So some of them are HELOCs, which is home equity line of credit, is what it stands for. And we have a few that are fixed. Most common one are the HELOCs, and those are they are amortized over 30 years, but they're due in 20 years. So, and after that 20 years, they'll have a balloon payment. So more than likely, and this, I mean, I've been doing HELOCs for a really long time. People will start with that, they'll use it, and then as they build the equity up, then we just consolidate the first and the second, and they refinance to combine those. They don't keep it normally for that long of a period of time to where somebody has that balloon payment. And the HELOC is an adjustable rate mortgage. So if you guys think of it, just think of it as it's a huge credit card basically for your house. I mean, because it's you have a certain when you purchase, you'll have a certain balance on it, but when you start paying down that balance, you can use that money again. It doesn't just go away. So that's kind of what a HELOC is, but it's another way, again, just a creative way to get around those jumbo guidelines. Because like I said, a lot of people don't have that 20% plus 12 months of reserves laying around. Any questions on the HELOC or the second?
I have a question about a HELOC. So like right now, how the rates are going up because HELOCs are adjustable. I mean, because the market is still like great, and a lot of people would have a lot of equity in their home. Would you suggest for people to still go and like go get a HELOC right now, even though the rates are going up because they're adjustable still?
So that's a good question. So right now it's just super volatile, and especially, you guys probably heard about the feds yesterday and raising the federal funding rate. That affects HELOCs. So, and short-term loans. So right now, yes, getting a HELOC, people are going to see some adjustments in their rates, and they're going to go up. But it kind of depends on the situation. So like if somebody, I've had it to where somebody wanted to they weren't quite sure yet if they wanted to sell their home, but they wanted to use the equity out of their home to purchase another home. Sometimes it makes sense to go, depending on the loan amount and what their need is. Sometimes it makes sense to go and get a HELOC and have that money instead of doing a full refinance, because what's going to happen is if I do a refinance, I do that loan for somebody who I know that's going to go out and buy another primary residence, I have to do that refinance as an investment property. I can't do it as a primary, even though they're still technically living in it because they haven't touched yet, but they are going to move out of it. They are not going to occupy that home as a primary residence for the next 12 months if I do that refinance. So we have to refinance it as an investment property. And sometimes that doesn't make sense because the cost and because of the interest rate as well. So if it's maybe for a shorter period of time, you can get a HELOC for $500 they charge. And it's not always the fastest way to do it, but it's a cheaper way to do it, especially if you need maybe some money for a shorter time So if they're wanting, and it kind of just depends on their first too, and kind of their situation of whether I would suggest somebody doing a HELOC or not doing a HELOC. But and especially because it's kind of a little volatile right now, I think it's gonna, what we're hearing, it's gonna get worse before it's gonna get better, and it will get better. And you guys will see that because things are pointing to more of a recession. And when that happens, that's good for interest rates. Inflation's bad for interest rates. And kind of first quarter next year, we'll see some relief. So, but yeah, for right now at this, it's all going to depend on the situation, if I would recommend that or not. Anybody else? All right. That was pretty much it. Like I said, that was kind of our last kind of series of like loan types of, we did FHA, we did VA, and I wanted to touch on conventional and, jumbo with the 80-10-10. So, if you guys, have any questions about it, again, everybody's situation is different. What product we put them in, whether it's conventional or FHA, obviously VA. it just depends on their situation, the parameters, their needs, all that. That's kind of what we do when we look at everything to kind of see what is the best way to structure their loan for them. So sometimes we got to get a little creative too, but we do it definitely to always put them in the best situation and the best financing possible. And how's everything, just out of curiosity, I haven't talked to you guys in a few weeks. How's things going for you guys out there? Are you slower? Are you feeling some hesitation from buyers, sellers? Kind of what's been your guys' feedback lately with the way the market is?
I think people are scared. Honestly, I think that they don't want to make a big investment right now with what rising costs of everything else. So they don't want to have to sock extra money aside for that 12 months of, solid, of savings. And it's just, I think people are scared right now.
Yeah. Yeah, and I think I've been doing this almost 20 years, and it wasn't like they kind of gave us some time to adjust, to these rates. It was like, bam, we're there. It was like from January to March, and we're like 2 points, and I've never seen that before. And I've seen a lot of markets, but that fast of a change within a short period of time, and I definitely. I see that with scaring people, because, the other thing we're running into is people qualifying now the rates have got. So somebody I qualified in January, their purchasing power went down probably about 20% if I re-qualified them right now, because kind of rule of thumb is a point or 1% rise in an interest rate decreases your purchasing power by 10%. So it makes a difference, and it can throw some people off on what they qualify for, especially if we're kind of at their max, like debt to income ratio. So I would suggest to you guys, if you have people that have been pre-approved, like January, February, have them, talk to them and say, hey, get back with your lender and get that refreshed, because things have definitely changed since then. So that would be a recommendation of mine. But like I said, it's going to get better. It's going to get better. We might not see some relief till next year, but it's going to get better. You just watch, and then we'll have a party. But if it doesn't get better, then don't call me. No, I'm just kidding. It is. But so there is hope, and we just have to ride this out for a little bit. Just ride it out for a little bit. Make people, and you know what? And I remember interest rates of 7, and we thought that was great back in the day. Like, that was awesome. But again, it's because I think it's done it so quickly that, and you're right, Greg, it's kind of some fear, and the media doesn't help with that as well. So
No.
yeah.
Question for you. I have a question for you. You said that a jumbo is what right now? So
it depends on the county, but in like Solano County, it's anything over our conforming loan limit. So 647, 250. So anything over that is considered jumbo.
Because right now the properties that people are interested in, on an average is from 575 to 725. So as soon as you get to that 725, you're looking at a jumbo. And anything with a 3-bedroom, 2-bath is going to be in the 650 time or in Solano County, unless it's a really big fixer upper.
And just remember, it's not purchase price; it's loan amount. So, the loan amount has to be at the 647, 250 to not be considered jumbo. So, if it's a $700,000 home, well, then they're putting $43,000 down. I mean, if they can, to stay out of that jumbo world. Or, like I said, we could structure it as like an 80-10-10. So it just depends. But yeah, so it's loan amount, not purchase price. So just remember that as well.
The other question, I missed the VA session. What's VA cap at right now before it goes 25 cents on the dollar?
There's no VA cap. So they changed that a few years back. So somebody could buy a $2 million home with 0 down.
You're kidding me.
No.
No, that just changed my whole world. We're gonna have a conversation later.
Yeah. Call me up. Would love to talk.
All right. Thank you, Sonia.
Yeah, you're welcome. And you know, one thing, since we already did the VA one, but I wanted to mention this because I didn't bring it up. And I just forgot, but it just got brought back up again because it doesn't happen often to a client that I just closed on. So if you guys have a client that has a VA client, they have 100% disability rating. I don't know if you guys know this, but they can apply with the county and they get a tax exemption. And it doesn't, I mean, it doesn't even have to be a VA. Somebody can, like my husband's a police officer, he's gotten injured on the job. Probably by the time he retires, he'll have 100% disability. But if they have 100% disability rating, their property taxes, they'll get an exemption. So my clients, oh, and what is it? I will send it to you guys. It is, and it changes through the county every so often because of cost of living. So I believe it was $249,000. Maybe it was $149,000. I will send it to you, but it lowered their taxes about $200 a month. So it was a pretty good savings for them. And not a lot of people know about it or how to do it. I mean, they have to apply through the county and then get it approved, but it's a pretty decent savings for somebody. So just
it's a great savings, and I have a friend of mine that actually applied for it. The kicker is for the last 2 years, they haven't been applying it to his account. So he's fighting with the county right now in Solano County, that savings like accredited back to him some way or another, because somebody did check a box somewhere on some system. And he got the letter of approval that he's 100% disabled. He's 60 years old. And for the last 2 years, he was supposed to have this credit. And he's like, my taxes haven't changed at all.
Yeah, definitely tell him I mean, the county. Yeah, I mean, I have to say that I just did the refinance for, and she's VA, and it did take like months before she actually got her paperwork approved. And now she's got to send it to the lender so they can adjust her property taxes with the exemption, but it's totally worth it. So tell him to keep fighting for it. I mean, tell him to, talk to
Most
whoever,
definitely.
to get that taken care of, because they deserve it. And, they need to fight for that. So, but a lot of people just aren't aware of it,
Yeah, they try to keep that kind of stuff quiet.
Yeah, exactly. So, but I thought I would just bring that to you because it just happened on one of my clients. So it doesn't happen very often, but.
Yeah, please send that out, because I kind of focus my customer base on VA. I'm 90% working on getting my 100%, but yeah, it'd be great to get that as well. So
yeah, and it's a document from the county, because like I said, it changes. And I mean, it was actually even a pain to kind of get this new info from the county, but it does change. So you can actually, what I'm going to send you, you'll see, like, I forgot what year, but you can kind of see like the difference, that it has changed over the years, but like I said, it's going to save them about $200 a month. So it's a good thing.
Appreciate it.
Absolutely. Well, you guys let me know if you have any questions. Thanks again for, jumping on and listening to me. And I'm here if you need anything, and you guys enjoy your weekend.